Welcome to the morning news show, still unnamed, here at the very recently. I guess we're airing live, but we're very much beta testing everything we're doing here, and we're calling ourselves Big TV in the most ironic way because we're tiny now, but we have big ambitions and big goals. And one of the things we really want to do is highlight the actual news that matter for traders. And so we're working with the guys at Live Squawk, and we have Harry Daniels here, the voice of Live Squawk. Say hello, Harry.
Good morning. Good afternoon now, I think it is. Good afternoon.
Yeah, we're a little late, so it's a lot of work. So we started purposely a little late today. Just, I mean, when you're in front of a camera and you look green, it's not good. So, so you have to be a little happy where you are. But there's some action going on. I mean, we've seen a bunch of things in the last 24 hours. Personally, one of the most interesting things from my angle is I'm gonna maybe be the sale of Motorola Mobility. Have you heard any feedback on that? Any focus on that, or do people care at all?
I guess in the context of everything going on, it plays a minor role in the bigger picture, really. But yes, that was one of the stories that we caught from the Asia session overnight. Big deal for biggest. Is it the biggest deal you said?
No,
From
no, no.
China.
It's just something I care about.
Oh, I see.
No, so I want you to just do a rundown of the stuff that you've been talking on the Squawk, and we can talk a little bit about some of these subjects.
Yeah, sure. Well, I guess the flight to quality is still there. That flight to safety for bond markets is evident. We broke through 2.7% yields for a US 10-year, lowest have been since October, I think, of last year, mid-October of last year. So, which just denotes that despite the tapering effect or the tapering that was seen last night, as expected from the FOMC, um, the need for safety hasn't gone away. I talked to a CDS friend earlier today, and he tells me there's the market's very erratic at the moment. There's still a need to for safety, a need for insurance there of some corporate debt at the moment, and the ITREX indices today are all over the place, which shows a level of nervousness and volatility that just denotes anything but a settled environment overall. So I think ultimately you look at the dollar, and that there's some safety plays going through there. Obviously, there's a bit of the US FOMC move there as well. But currencies, the emerging market currencies, which have been the focus of late, are still providing a level of uncertainty, and the markets are jittery here really today. And
So can we talk a little bit about the emerging market? Because I've seen some comments now from fairly reputable sources saying tapering and all this is hitting the South African rand, Argentine. Well, I guess it's the Argentine the bleu, the
mm.
the real rate of the peso, and then also the lira. What do you think? Do you think this is legit? I mean, it seems so far fetched that.
It is. It is. I mean, I'm sorry, but if you're a central banker, if you're or a trader even, and you've not prepared for a Fed taper this month, um, and think that it's taking you by surprise, you really shouldn't be in the game. I mean,
Yeah.
it's been more. It has been priced in. This, part of what we saw pre the FOMC was the pricing in of that tapering and the problems they have. I think this is China. This is emerging markets. This is the lack of growth. This is that fight to the fight for currencies. You just think if you start raising or hiking rates, as we've seen in the nature we've seen for a lot of these emerging markets, you're stunting growth. They've got imported inflation now. They're now going to get restricted growth environment on the back of higher rates and higher borrowing levels. It's not a good scenario and good um, spiral to be in, and I think that it's feeding on itself as much as anything else. And what we haven't really seen is a contagion. I know we've seen the markets and equity markets respond and negatively to what we've seen in emerging markets, but if you think this is some sort of bloodlet and sell off in equity markets, you haven't really seen a proper shanking or shaking out of longs in an equity market bull run. So, you know, the contagion effect is I think still relatively limited and contained for the time being. But again, these things develop over time, and we'll have to wait and see the next sort of couple of weeks, see if it starts to calm down, or whether, as I said, it feeds on itself and causes a spiraling effect and more central bank battles over currencies.
That's a very interesting point because we had you on. We did some trials yesterday. A very interesting one. We had quite a few viewers tune in when we were just really looking at markets. We didn't have much content because
Mm,
all we saw was talking to you because we had some problems connecting yesterday.
sure.
And talking to you, it just occurred to me that this could be it.
Mm,
So the reason why yesterday was important, and I was talking to an asset manager friend of mine, and he said you shouldn't care about 2 hour perspectives, but you shouldn't disregard it just because it's short term. And I'm thinking what we're seeing now is we're seeing some kind of shift in focus, shift in central bank sort of sensibilities, for lack of a good term,
mm,
and we're seeing stuff like the Argentine peso getting so much attention and
mm.
having this real ability to shake up markets. And you're seeing, I mean, it is it's not maybe not contagion, but it is affecting stuff like E-minis. So there is some global risk of
You
thing.
can't help that. I mean, in today's world, in today's um, accessibility, markets are easily accessible just to, for them, even just to look at, and you can't help but this introspection. 20 years ago, it would have been a different story. You'd have heard it secondhand from one of your brokers, whereas now you can pull up a chart, you can pull up a news story, and you can read it for yourself in 5 minutes, and that causes this again frenzy, feeding frenzy on a very polarized situation, and that's not going to change now. It's a new world. It's where we are. The way social media goes now, you're far more up to speed with events or supposed events, as you see on Twitter, on social media, and you react to that. So that it's polarizing. It's not going to change. But yes, your friend's right. You shouldn't look at a 2 hour window and assess the whole of the first quarter on it, or you shouldn't make investment judgments on the back of 2 hours. But there is always a point. There's always a push point that turns a bull run into a a negative run, into a bear run. So and we may be at that point now. We may be at the point where this evolves into a bigger liquidation of some risk assets. There is obviously the money moving back into more established markets from emerging markets out there, because the yields are coming back. You look at the growth prospects for the established markets, and they're coming back, and because developed markets say, and because of that, you are going to get some funds coming out of emerging markets, because you don't want to hold such a high risk sort of paper over more secured risk with better yields, as we start to see better yields come through. So some of it makes sense, some of it is timely, and some of it is a panic to a polarized situation. As I said, I don't think the contagion's spread. You look at the Spanish yields at the moment, and you're not really seeing at the moment any real worry. We just sold some the 3-year paper today. I was not 3-year, 5 and 10-year Italian debt today at euro era lows for the 5-year. So if it was that much of a worry for the global economy, we would be seeing the euro era low borrowing levels for a 5-year and multi-year lows for a 10-year. So the bigger scheme of things is don't panic. I don't think it's a panic situation yet. I just think it's one you have to be wary of.
But that's also why I'm just bringing it up, because yields are not reacting. So I have a chart up on the screen. I don't know if you can see it. It's Spanish 10-year,
Mm,
and this is the yields in the last since January 1st.
mm,
And I mean, it's clearly not in a panic state,
no.
but uh, there is a notable shift in how people talk about the global economy and
Mm,
what people are preparing for. So I'm just saying that maybe it's important to be sensitive to this, and not just say that it's not 2011, it's not 2008, and I don't think it is,
no,
but
no, nowhere near.
but there is this palpable sense of confidence in traders who made the best year of their life last year, and they don't know. They don't really know why. I think, and we have. I don't know who said this. There was a famous trader. Actually, it was in a book, but it was very good. It's in the book. The name escapes me, but when he talks about how it was like to sell subprime debt, I'm
Right.
getting richer, but I don't know why.
Not Market Wizards, was it?
Uh, well, no, no,
Something
no,
similar.
not Market Wizards. It's in a fictional book, but I like the quote a lot. It's in oh, the name escapes me. The Fear Index.
Ah, I see.
Oh,
Yes,
I
I get
love the
you.
book, The Fear
But
Index.
listen, we're at an inflection point.
Yeah,
You know, in the world global economy, we are moving into. I wouldn't say we're in escape velocity, but we are moving to a growth environment. And when we've been geared up for such, we've had our tin hats on, if you like, and geared up for on the defensive. You know, to get out that mindset and to start thinking along clear lines is you know, it's hard sometimes for the bond markets. I think in that sense, for equity markets, we've been on a rally for the last sort of year and a half, 2 years now on the back of the QE and the wash of liquidity. You know, that's coming to an end. So we're in an inflection point. We're looking for growth now to pick up and take over the baton from where accommodative policy has been the main sort of crutch. And you know, that takes a bit of confidence. You need a bit of confidence before you decide to throw away that particular crutch and start walking on your own two legs again if you've broken your leg.
yeah.
And that's the analogy I put it.
I think it's quite beautiful the way you put it, and I totally agree. And it's also you have to move into this world with, for lack of a better term, a lot of shades of gray,
Yeah,
and the world is it's never coming back, or at least not soon, to that crazy days of 6.66% moves on the Dow or whatever that was.
mm,
But we do have special cases. So on the screen here, I have the U.S. HUF, Hungarian forints. It's moving 3.5% today. I'm guessing it's off of those rumors yesterday. Did you report that? Because I saw that from a competing service.
um,
And
remind me, I might not have been here.
that I don't know the exact wording of it, but it was something to the line of Hungary will uh, not make a payment on one of his bonds, which I guess is a technical default. I'm not sure. Nobody
Yeah,
said that word, but if you don't make
yeah.
a
If you
payment
don't
on
pay
the
your money back, you're
yeah,
defaulting.
I
I
mean,
don't care what we
if
call
you
it.
use Rogoff's definition, it would be a default.
Yeah.
What's interesting is the Hungarian central bank did say no comment,
Mm.
and it's in this world of central banking that was kind of curious. And you look at the hoof doesn't look that great, this chart. So did you not hear this? I mean, it's been dismissed as a stupid rumor.
And I totally agree. I mean, if the central bank, look, it's not for the central banks to comment on every rumor that comes out in the markets. They
Of
don't.
course.
Any credible central bank wouldn't do that, and I don't think Hungary are any different in that sense. No, you know, it wasn't something I was overly concerned by. You know, we've got all sorts of stories flying about at the moment, and you know, that's another one. That's just another one doing the rounds at the moment. What you do get in situations like this are you often do get these spurious rumours doing the rounds because people are susceptible to listening to these things
Yes.
in this sort of environment. You know, people are far when markets are banging around. You look for a rumor to fit the move.
Yeah, of course. But we haven't had much rumors lately, so it was almost refreshing to have a rumor in some
Yeah, maybe.
weird way.
Yeah, yeah,
Do you
yeah.
guys report on rumors? What's your policy on that?
Well, we try and corroborate everything. We'll put if it's moving the markets, then whether it's true or not, it's having an effect. So our policy is, look, listen, this is we warn our guys. This is not based on fact. This is based on conjecture and rumor. Take it for what you will, and we are investigating, and that's
Yeah.
what we do. We'll try
So,
and you know if there are rumors out there, we'll try and either corroborate them or you know flush them out to be the lies they are.
yeah, I like that. And
That's the idea.
rumor mongering is very dangerous in the world of finance. So
We saw what he got us
I
in
haven't seen you guys
2008.
be reposting. I mean, it's a cheap trick to everyone loves a rumor. It's like a
Mm.
rumor, other people's sex lives, these things like naturally people like to talk about for some
It's human
reason.
nature, yeah.
Yeah, it really is human nature, but I think in finance it's very dangerous. I've made a point of stopping to addressing rumors, at least on Twitter, because when you have a certain amount of following, you can actually
Yeah.
affect stuff, and it's just negative. So I make a point out of not at least unless it's moving markets very like deeply.
Yeah,
But
we won't propagate them. We'll recognise if we'll recognise the fact that there's a rumor doing the rounds, and we'll try our best to try and, as I said,
yeah,
bring a bit of fact to the situation.
yes,
But yeah, ultimately, I think today, moving on other events today, I think you're looking at GDP for the US really to show continued growth. And the only worry on that front, really, in terms of what we're likely to see, is whether you'll get a below par reading expectation, really, and whether it's based on the weather, bad weather at the back end of last year in the States, and the government hiatus feeding through into the actual productivity level. So that's the focal point, I think, for this afternoon, really, ahead of next week's flurry of central bank decisions and events, really.
yeah. So I'm just looking at the schedule. I have the schedule here from the in-front terminal, the
Hmm.
terminal of choice here, and I'm just looking at the schedule here, and we're seeing some. Tomorrow we have ISM. Do you have any interesting things off the night? There's quite a few Japanese numbers. Are people still caring about Japan?
I think we do. You take it separately from Asia as a whole generally, but again, you're looking for signs really of an inflationary environment. You want to start seeing this prices feed through in a more determined way. I still think the central bank and the government themselves are in a bit of a flux. You've got this tax hike, corporate tax hike coming, the VAT hike coming, and I think people will want to see how that affects growth and prices down the line
Yes.
before the central bank itself wants to jump in and do any more. At the moment, it's very sanguine on the effects of the tax hike, but we'll see how that plays out.
Brilliant.
But most of Asia out really now. Tomorrow for definite into the Lunar New Year. It's going to be a bit of a quiet session outside of Japan, and we're not expecting too much going into the end of the week.
It's brilliant. I love these updates because I don't have time for this so often. So I mean,
Hey, that's
it
what we
really
do.
is. I repeat this. I mean, you guys have to. The people watching, you really should sign up for the Live Squawk service. I'm actually not using the. I never log in. I
Mm,
use the one thing I use is the email. And I told you that before, the email, because in my life I have to sort of segregate this a little bit.
sure.
And if I have the email here, I wanted to show it. One second, I wanted to show it on camera because it is. I don't know. I think Jason that you. So here is the morning news.
Hmm.
Just one second, pulling it up here. So this is the email I get from Live Squawk every day, and it really is a beautiful way to just like wrap like everything is sourced, everything is linked. It's the most important things. You have some this you can read it in 2 minutes, 3 minutes. So I want to applaud you guys for it. I never thought that
Thank
would
you.
be what I liked. So anyway, the viewers should sign up. So I guess that's it. We're at about 18 minutes, so maybe it's a little long for you. What do you think? Is it too long?
Only in terms of other commitments I have now, but we can work that out as we go along.
Yeah, brilliant. Okay, thank you for helping me out today, and see you tomorrow.
See you tomorrow.
Okay, cheers, bye.
Bye, sir. Bye.